corporate earnings news we've had this morning has dented the futures coming into the open. There just seems to be an appetite to want to buy at the moment.
Scary, yeah?
Well, we're just trying to understand what it's about. What do you think it's down to?
Well, I mean, it is quite interesting that a number of earnings reports have disappointed. It's obviously, by standards of the past few quarters, it's a bit of a shift to the downside. But we came into the year with people full of fearing 08, if not worse, etc., etc. And the evidence from all over the place is that it's nothing like 08. At the core of the Eurozone, to me, probably the single most interesting out of many stories all over the world is that Germany appears to be accelerating. So 1/3 of the Eurozone that's supposedly falling apart is actually improving. China appears as though it's getting closer to this sort of rather simplistic notion of a soft landing, and the US also showing signs of moving forward. So the key, I mean, there's always risks out there. To me, the key to this market movement over January is that people were worried about everything that could go wrong, literally across the board, and with it, staggering amount of cash around. So just the cessation of bad news itself has sort of appeared a bit of a positive, and we've actually had some positive economic news as well. I was just looking at some of the details of the China Q4 and implied underlying numbers yesterday. And we kind of forget it a bit because of this European thing, but last year China went from 5.9 trillion the year before to 7.3. China's created $1.4 trillion of GDP in a year. You know, that's 10% of the Eurozone in 1 year. I used to say on here, China creates the equivalent of another Greece every 4 months. It's now less than every 3 months. They're creating half the United Kingdom every 12 months. And so there's a ton of, you know, ongoing stuff going on out there, which at some point, if the world isn't falling apart, people have to say, oh yeah. But I mean, of course, there's plenty of risks.
Yeah, sure.
Actually something that meets your criteria.
Yes.
In this space, what
Yes.
does?
Well, basically, what I've been doing recently, at the end of last year, I bought some Swire in Hong Kong, Swire Pacific, Songhai Properties and Hang Seng Bank. And then in Thailand, we had a collapse of the industrial estate companies because of the flooding. So I bought some Rojana and Ticon Industrial, because they have very high yields. So I think, I mean, the markets, they're moving up. We have a tidal wave of liquidity being injected by all the central banks around the world. And the economies may not do particularly well, but asset prices one way or the other can go up. Now, the big thing is this. In the 70s, when you printed money, it went into wage inflation and consumer price inflation. Now it goes into asset price inflation. The trick will be to get out of assets at the right time.
How do you know when the right time will be?
Yeah, that is precisely the point.
When the bubble
That
bursts.
is precisely the point. And also you have one bubble after the other. You understand? You print money here, and then one asset class goes up, say stocks, NASDAQ, until 2000, then the real estate market in the US until 2007, then commodities, and more recently art prices have been very strong on the high end, wines and so forth. And so the trick is really to move your money from one asset bubble to the other.
Are we close to a collapse in any of these bubbles yet?
Well, I think the stock market this year has started in a similar way as in 1987. We're up in emerging markets by 11.8% in January. India is up 19%, silver is up 19%, gold is up 11%, and so forth and so on. So if this continues, we're going to get an overvaluation somewhere between, I don't know, March to June of this year, and then we could have a big setback in the second half of this year.
Wow.
We've got to get things aside of the break, but I've got to...
actually been bullish for some time, and he looks at this market as an historic buying opportunity. We are speaking of none other than Jeremy Siegel, professor at the Wharton School of the University of Pennsylvania. Jeremy, great to have you with us today.
Happy to be here, Mandy.
I know that you caught some of Ben Bernanke's speech this morning. He talked long, he talked large. What was the chief takeaway for you? What was the most important point?
Well, I think he's reinforcing what he said from the FOMC conference, and they said 2% inflation. He wasn't going to sacrifice that inflation rate. You know, that is the new goal of the Federal Reserve. He's prepared to stimulate the economy more, but he does know about inflation as one of their targets. So I didn't see anything that new, just a reinforcement of what he had said.
Okay, so what's your take on the U.S. economy right now?
Well, I think this year is going to surprise on the upside. I think Europe is improving. I think that
improving. Most people feel that it's going into recession, or in some countries already is in recession.
They kicked the banking crisis down the road. And that is the main fear for U.S. investors, is that banking crisis. So if that is taken off the table for the next 6-9 months, I think we got upside here on the U.S. market.
But that's just kicking the can down the road.
It is kicking the can down the road. You know what's going to be? Depreciation of the euro. We're probably going to see it at $1 per euro, and that's going to be a last chance to sort of save the euro system.
Before Sully jumps in, you're saying $1 per euro, so parity in what time frame,
Oh,
sir?
boy. You know, they say pick one or the other, but not both. But I wouldn't be surprised in, say, a year and a half. But you know, don't kill me if I'm wrong, but I wouldn't be surprised.
Okay, another euro.
You say this is the best time, you've never seen stocks as cheap as they are today since 1982. Explain. This
Yes.
is good news.
Well, the averages are way down. I think back in 2000, the S&P was somewhere around 28 times earnings, and normally it's probably about 17 or 18. And now I think on 2012 earnings, it's around 14, 15. So it's very cheap, and companies are strong. Cash flow is good. Finances are probably the best they've been in years. And people are just terrified to go near stocks at this point. These huge outflows to out of mutual funds. I guess they're $200, $300 billion last year alone. I just have made people just want to be out of the market because of the huge volatility and the belief that this depression-like environment will go on for forever.
Talking about earnings, do you see any threat to earnings in 2012, 2013 from overseas? I mean, Europe's going in a recession. Singapore had a bad fourth quarter. We're moving, but not nearly what we should after a severe downturn. Do you think earnings could have a nasty surprise that could upset your scenario? Or do you believe that even if earnings take a nick, they're still so cheap, these companies, that they're still worth buying?
Well, I think there could be. It's hard to fine-tune earnings, and they could take somewhat of a nick because of European operations. But the stocks are still very, very cheap, and I don't think it would be a huge nick. Germany's holding up reasonably well, and we weren't hurt much by what happened abroad this year. I don't think we're going to see foreign trade collapse like it did after 1929. I think there might be some changes, but I don't think they'll be very major.
We'll go through.